Imagine looking at a company that just, grew its revenue by 70%.
Right.
A company that completely doubled its profits
Yeah.
and generated roughly $4 billion in pure, unadulterated cash over the last year. I mean, you would think that stock would be untouchable, right?
Oh, absolutely. You'd expect it to be flying high.
Yeah. But now imagine checking the chart and seeing that same stock plummeted 40%.
Okay.
Welcome to the incredibly confusing reality of navigating the 2026 stock market. You step to the left, and a technical indicator is screaming at you to sell.
Right.
You step to the right, and the fundamental cash flow is flashing this massive neon buy sign. It is completely disorienting for anyone trying to manage their own portfolio right now.
That disorientation is, well, it's the defining characteristic of this current market. We are operating in a landscape where the signals don't just gently conflict. I mean, they actively wage war against each other.
Yeah, they really do.
And that is exactly why so many investors end up paralyzed, holding the bag or making these emotional decisions at the absolute worst possible times.
Which brings us to the centerpiece of today's deep dive. We are shining a massive spotlight on one specific stock that perfectly captures this feeling of like walking through a financial minefield.
AppLovin.
Exactly, AppLovin Corp, trading under the ticker symbol APP. To set the scene for you, today is Monday, April 20th, 2026. Right now, AppLovin is trading at $477.20.
Okay.
It's actually showing a bit of a short-term recovery trend today, up about 2.38%.
But we have to pull back and look at the macro picture here because that little daily green bump.
It's hiding the real story.
Exactly. It's masking what has been a wildly volatile year. If you look back to their December highs, the shares plunged anywhere from 20 to 41%, depending on where exactly you draw the line.
Wow.
It has been a brutal, unrelenting few months for anyone who bought in at the absolute top.
Brutal is the right word. I mean, you've got some analysts throwing up red flags and flashing sell signals, while others are literally banging their fists on the table claiming this AI powerhouse is drastically undervalued.
It's a huge divide.
It really is. So our mission for this deep dive is clear. We are going to unpack the financials, we're going to decode the technicals, and we're going to weigh this intense bull versus bear debate.
And just as a quick reminder for you listening, we are here to break down the source data and the mechanics, not to give you financial advice.
Right, no financial advice here. Okay, let's unpack this. Looking at AppLovin's recent stock chart, it genuinely looks like a roller coaster that just hit the absolute bottom of a terrifying drop and is now slowly, painfully clicking its way back up the track.
Yeah, that's a perfect visual. And surviving a chart like that requires stripping away the emotion and relying strictly on the data. If we look past the dizzying drops, we can actually map out the mechanics of this ride. And our primary focal point today is going to be their upcoming Q1 earnings catalyst on May 6th.
Okay, May 6th. So to understand what might happen then and why the stock is moving the way it is right now, we have to look at what's actually powering the machine under the hood.
Right.
Because before we stare at the squiggly lines on the technical charts, we have to look at the actual business. The label AI powerhouse gets thrown around so much these days. What is AppLovin actually doing to earn that title?
So the engine driving this entire conversation is their proprietary AI advertising system.
Okay.
It's called AXON 2.0.
Yeah.
And to understand why this matters, you have to understand the modern mobile ecosystem.
Right, because there are millions of apps and games out there.
Millions, all competing for your attention. So AppLovin's AXON 2.0 uses predictive algorithms to match mobile game ads with the specific users who are statistically most likely to actually spend money inside those games.
Oh, wow.
Yeah, it doesn't just show ads, it finds the most profitable eyeballs on Earth. And the full year 2025 numbers driven by this engine were, frankly, staggering.
So just how much cash are we talking about here? Because, the phrase staggering numbers is another one that Wall Street loves to overuse.
Fair enough. Let's look at the actual income statement. Their annual revenue hit $5.48 billion.
5.48, okay.
That is a 70% year-over-year growth. And it's not just like top-line vanity metrics where they're spending $4 billion to make $5 billion.
Right.
Their net income came in at $3.33 billion. That's up 111% annually.
111%. That is insane.
Yeah. Adjusted EBITDA, which measures their core operational profitability, was $4.51 billion. But the metric that truly defines their power is free cash flow.
Yes, free cash flow.
Which came in at a massive $3.95 billion.
Wow.
That is a 91% jump from the previous year.
See, free cash flow always feels like the ultimate truth teller to me. Like, that's not some accounting trick on a spreadsheet. That is the actual physical cash left over in the company's bank account after they pay the salaries, keep the server farms running, and maintain the business.
That is the perfect way to look at it. Generating nearly $4 billion in free cash flow means AppLovin has immense optionality to maneuver.
Yeah.
And you see that strength reflected on their balance sheet as of December 31st, 2025. They are sitting on $7.26 billion in total assets against $5.12 billion in total liabilities.
Okay.
And their cash and equivalents alone surged to $2.49 billion.
But see, this is exactly where I hit a wall with this entire narrative.
How so?
Well, if they have this magical AXON 2.0 engine and they are breaking historical financial records, literally doubling their net income and swimming in billions of dollars in cash, why in the world did the stock collapse?
Right.
I mean, I'm looking at the chart and it fell from a 52-week high of $745.61 all the way down to a low of $222.02 before this recent bounce.
It's a massive drop.
It's like a runner shattering world records on the track, but the crowd is just throwing tomatoes at them. It makes zero sense.
What's fascinating here is the severe disconnect between trailing financial success and forward-looking market sentiment.
Okay.
Because Wall Street is inherently a discounting mechanism. It really doesn't care what you did yesterday. It cares what you are going to do tomorrow.
Right.
And more importantly, it cares about the rate of change. When a company posts 70% revenue growth and over 100% net income growth, they set an impossibly high bar for future expectations.
So the market starts pricing the stock as if they are going to grow at 70% every single year for the rest of eternity. They basically become a victim of their own unbelievable success.
Exactly. The market demands perfection at those valuations.
Yeah.
If institutional investors even catch a tiny whiff that the massive growth rate might slow down, not go negative, mind you, just slow down to, say, a 30% growth.
The panic.
They reprice the stock violently.
Yeah.
Massive growth breeds massive expectations, and massive expectations breed massive multiple compression when reality sets in.
Okay, so if the fundamental cash flow is historically great, but the price still drops so severely, it raises a crucial question for you as a listener trying to make sense of this. Like, who exactly is holding the bag right now?
That is the right question.
Let's follow the money. Because when I look at the order flow over the last few months, we have a serious, high-stakes tug-of-war happening.
It is a tug of war. And the first pull on the rope comes from the insiders. Over the last 90 days, executives at AppLovin, and we are talking about the very top brass here, including the CEO and the CTO,
Okay.
they've sold off roughly $169 million worth of their own stock.
Wait, hold on a second. If the CEO and the CTO are aggressively dumping nearly 170 million of their own shares, but earlier I read that the company itself authorized a massive $3.2 billion share buyback program.
They did.
How can that be? Here's where it gets really interesting. The leadership is selling out the back door while using company cash to buy shares through the front door. That feels like a massive, glaring red flag.
It absolutely looks completely contradictory on the surface, which is exactly why retail traders often misinterpret these mixed signals and just panic.
Yeah, I would panic.
But you have to separate personal wealth management from corporate capital allocation. Executives at tech companies receive a massive portion of their overall compensation in stock options.
Right, of course.
So taking personal profits, paying massive tax bills, or simply diversifying their own personal portfolios, well, it doesn't inherently negate the bullish signal of the company's actions.
Because that $3.2 billion corporate buyback is fundamentally changing the math for everyone else holding the stock.
Exactly.
If the company takes billions of dollars and buys its own shares off the open market, those shares are retired. They disappear. Which means the total number of slices in the pie shrinks, making every remaining slice, including yours, worth more. It artificially boosts the earnings per share.
And the institutional smart money understands that math perfectly. While retail traders might panic over insider selling, professional institutions are actively scooping up those shares.
Yeah.
We are seeing major players like KBC Group and Farther Finance Advisors significantly increasing their stakes right now.
And it's not just who is buying, right? The timeline of when they are buying is a huge tell.
Oh, absolutely.
The data shows consistent intraday strength in the final hour of trading sessions. Now, retail traders, You know, the average folks at home usually trade right at the opening bell based on emotion, overnight news, or panic,
Yep.
but institutional algorithms and massive block trades happen right near the closing bell.
They do that because massive funds use execution algorithms like VWAP. Yeah, volume-weighted average price. They can't just click buy on a million shares at 9:30 a.m. without causing the price to absolutely skyrocket and ruining their own entry point.
Oh, that makes sense.
So they spread the buying out all day, but they heavily weight it near the close to secure the official closing price. So that final hour strength you are seeing, it's a massive, unmistakable footprint of institutional accumulation.
Okay, so with institutions quietly buying the dip and loading up before the close, we need to bridge this over to what the actual price action is telling us on the screen.
Right.
Let's decode the technicals to understand the actual momentum of the stock right now.
The technical picture is just as paradoxical as the fundamental one, honestly.
Really?
Yeah, the overall trend for the year is still undeniably bearish because of that massive drop from the $745 peak. However, the short-term trend over the last few weeks has shifted to neutral to bullish.
Right, because the stock is currently trading at $477.20. And technically speaking, that means it has successfully climbed well above its 50-day moving average, which is sitting at $429.49, and its 200-day moving average, which is right at $430.02.
Yeah, and for anyone tracking momentum, those moving averages act like the collective memory of the market. Crossing back above them is a significant display of underlying strength because it establishes a firm floor.
Like a safety net.
Exactly.
Sure.
Algorithms look at those lines as safety nets. Right now, we have immediate technical support sitting at $472.24, which is the recent daily low,
Okay.
and a much deeper, stronger safety net at that 50-day moving average of around $429. On the flip side, the ceiling, or resistance where sellers are likely waiting to take profits, is at $486.46, with a larger 30-day high resistance at $520.36.
But the chart is flashing a pretty major warning sign right now, isn't it? The 14-day RSI, the relative strength index, is currently sitting between 73.4 and 74.1.
It is.
Now, for anyone who doesn't stare at charts all day, how should they visualize the RSI?
You can think of the RSI as a measurement of how fast a stock is sprinting. An RSI over 70 is universally considered an overbought condition.
Overbought.
Right. It means the stock's price has risen too far, too fast, and is statistically exhausted. It's sprinting at top speed and is completely overdue for a short-term pullback just to catch its breath.
Okay.
However, the MACD indicator, which compares short-term momentum to long-term momentum, is actually still bullish. So while the stock is sprinting fast, it hasn't started actively losing acceleration yet.
Okay, but the terminology here gets incredibly tangled, and I think this is where regular investors get totally lost.
It's a lot to take in.
We're throwing around words like overbought, meaning it's too expensive and exhausted in the short term. But when you look at Wall Street analyst ratings, the sentiment is wildly bullish. Out of the analysts covering the stock, 21 rated a strong buy, 3 say moderate buy, and only 4 say hold. There are 0 sell ratings.
No.
And their average price target is $663.18. That implies a roughly 42% upside from where we are today. So how can a stock be mathematically overbought and drastically undervalued at the exact same time?
If we connect this to the bigger picture, the paradox resolves itself when you just separate the time frames.
Okay.
The RSI is a measurement of short-term trading momentum. It's strictly looking at the last 14 days and say, hey, this 2-week sprint was too fast, we need a temporary dip. But the Wall Street price targets are measurements of long-term fundamental valuation. They are looking 12 months down the road and saying, based on the massive free cash flow this business generates, a year from now, it should be worth much more.
And even among those long-term analysts, there is a massive split on what that future actually looks like.
Yeah.
You've got Array Research setting a conservative target of $340, while Jefferies is predicting it goes all the way to $860.
It's wild.
That is a $520 gap in expectations. It feels like nobody actually knows what this company is truly worth.
Which perfectly encapsulates the ultimate debate surrounding AppLovin right now. This collision of short-term overbought signals and long-term buy ratings brings us to the core question.
Right.
Is AppLovin a genuinely undervalued gem that you need to own? Or is it a classic value trap just waiting to completely crush retail traders?
Let's lay out the bull case first because the numbers are incredibly seductive.
They really are.
Platforms like Simply Walsend are looking at the discounted cash flows and claiming the stock is actually 51.8% undervalued right now,
Yeah.
and it's hard to argue with their operational efficiency. They boast an incredible 84% EBITDA margin. Their revenue per installation is up 75%. That AXON 2.0 engine isn't just generating revenue, its monetization efficiency is absolutely through the roof.
The software economics of an AI engine are just beautiful when they work.
Yeah.
Unlike a physical business that has to build a new factory to sell more products, when an AI algorithm improves, it scales with almost zero marginal cost. That is exactly how you achieve an 84% margin. You're printing money without printing physical goods.
Wow.
But every bull case casts a shadow. And the bear case here is remarkably heavy. The primary weight dragging this stock down and keeping those conservative analysts completely terrified is their balance sheet structure,
The debt.
specifically the debt. AppLovin carries a very high debt-to-equity ratio of 171%.
So what's this all mean for the listener? When I look at a 171% debt-to-equity ratio alongside a relatively high price-to-earnings ratio of 47.5x, it feels incredibly dangerous.
It is a tightrope walk.
Having an 84% margin is fantastic, but with that much debt on the books, aren't they basically trying to sail a massive fast ship while dragging a giant iron anchor underneath them?
That is a brilliant way to visualize the exact mechanism of a value trap. This is precisely why retail traders get crushed.
Right.
They look at a high-growth tech stock, they see the PE ratio of 47.5, and they just assume the 70% growth will continue forever in a perfect vacuum. They completely ignore the heavy debt anchor.
Right. And the danger isn't just the debt itself, it's the macro environment they are operating in. What happens when the wind suddenly stops blowing?
Exactly.
I'm thinking about the existential threat of AI disruption from advertising monopolies like Google and Meta.
We have seen this movie before. Think about what happened a few years ago when Apple changed its iOS privacy rules.
Oh, that was a bloodbath.
It completely kneecapped entire ad tech companies overnight because they just lost access to data. If the macro environment shifts, say, interest rates stay higher for longer, making AppLovin's massive debt more expensive to refinance, or if Meta rolls out a new algorithm that completely undercuts AppLovin's AXON 2.0 efficiency,
The ship stops moving.
and that high PE multiple will compress violently. When growth slows, the debt anchor pulls the ship under. The debt amplifies the downside volatility dramatically.
So it all comes down to execution. The bulls firmly believe the $4 billion in free cash flow is so strong, it will easily pay down that debt anchor and fund those massive $3.2 billion in buybacks, keeping the ship speeding ahead.
Right.
And the bears believe the heavy debt leaves them entirely exposed with zero room for error in a hyper-competitive AI landscape.
Both scenarios are mathematically possible, which is why the battle lines are drawn so fiercely. The market is just waiting to see which narrative breaks first.
So, bringing it all back to your perspective as the listener, try and figure out what to do in the immediate future. Where does this leave us as we march toward that highly anticipated May 6th earnings report?
Well, in the short-term outlook, between now and May 6th, you should expect high volatility. Because of that overbought RSI sitting at 74, a technical pullback toward that $451 support level is entirely plausible.
Just to cool off.
Yeah, institutional investors often take profits and position themselves cautiously ahead of massive earnings data, effectively de-risking their portfolios.
But the long-term outlook remains structurally positive if you believe the data. Wall Street is projecting an earnings per share growth of 57% for 2026. And a lot of that is driven by AppLovin expanding their AI engine beyond just mobile gaming and moving into the massive world of e-commerce advertising. There is a very real, tangible roadmap for massive growth if they can execute on their vision. Ultimately, the goal of this deep dive is simply to give you the tools to cut through the noise. When you see a stock plunging while its profits are soaring, you now know to look past the scary headlines.
Right.
You have to look at the glowing cash flow statements, but you also have to measure the heavy debt loads and form your own conclusions based on the actual mechanics of the business.
This raises an important question, one that every investor needs to honestly answer before taking a position here or in any AI-driven ad tech stock.
What's that?
Well, if AppLovin's AXON 2.0 AI is the primary engine driving this historic 70% revenue growth right now,
Yeah.
What happens if AI ad targeting becomes completely commoditized by the big tech monopolies over the next 2 years?
Wow. Yeah.
In a world where Google and Meta possess essentially infinite data, does a smaller specialized company like AppLovin eventually get bought out for a massive premium? Or do they slowly get squeezed out of the market entirely?
It really is a financial minefield out there. You step left, you find a cash-flowing AI gem with incredible margins. You step right, you hit a wall of corporate debt and looming big tech competition. Just make sure you check your map and your data before you take the next step.